Craig is outstanding at what he does in terms of health insurance. His knowledge base is amazing. And the reason I know that is because Craig serves as our health insurance chair on your NAFA Florida Board of Directors here statewide. So he does a fabulous job for us. What he will bring to you is fascinating, I assure you that. It's amazing some of the changes that have taken place in the past several months in terms of the healthcare industry moving forward. He's dynamic. I think you're going to like him a lot. And at this time, I'd like to present to you Craig Rodrigue of NAFA Florida. Craig, carry it away there.
Good morning, and thank you so much. I'm glad everybody joined. I think this is going to be an important webinar for a lot of us that write health insurance. It's important for those of us that don't write health insurance. We're going to cover some things that can really help your clients or maybe even help yourself. So here's my kind of guarantee to you guys is I can't tell you unequivocally this is everything that's happened since the first of the year. I'm just going to tell you it's everything I could find since the first of the year that I thought we needed to know revolving around health insurance, employers in the field of that I work in, the health insurance field, and some other information that I thought y'all would want to know. So we're going to get started with the No Surprises Act. And the idea behind the No Surprises Act, some of you may or may not know this, but I had a client one time, he had a heart attack. He goes to the in-network hospital, goes to the emergency room, and when he gets out of the emergency room, he's being billed as if he was out of network. And he's saying, well, I'm not out of network. I know I was at an in-network hospital. Well, what a lot of us don't realize is hospitals don't even run their own emergency rooms in a lot of cases. They may rent their emergency room to Craig's ER service, and Craig's ER service didn't contract with Blue Cross or Aetna or Humana, and so you're out of network when you're in that emergency room. Well, the No Surprises Act wants to address those things for our clients. And so this started in January. It'll start in January of 2022, and we're going to go through a couple of the things that it includes. The idea here was we wanted to prevent surprise billing in two areas: emergency rooms and air ambulance. Now, I pray to God that I'm never in an air ambulance or anything happens to me that I have to be. But the idea is that they want us all to be charged as if we're in network in those scenarios. So if we go back to this hospital room visit that my client had that had the heart attack, no longer could that hospital emergency room bill him as if he's out of network. And it's going to require the insurers to do many things. And so we're going to cover a couple of those things the insurers have to do. They've got to offer a price comparison tool for cost and services. And what's going to happen is they have to have an advanced EOB or explanation of benefits. That'd be kind of nice. If I needed surgery, I can figure out in advance, what if I do the surgery with Dr. Smith? What if I do the surgery with Dr. Jones? What am I going to pay for that surgery? What's the explanation of benefits look like before I ever do it, so I can make a more educated decision? Member ID cards will now have to show in-network and out-of-network deductibles and max out-of-pockets. Insurers have to review their provider list every 90 days to make sure that they're accurate. The last one on this slide is the one that's going to be pretty impactful, I think. One of the other things they're upset about with the No Surprises Act was they were upset because claims would drag on and on and on. I'd go to the doctor would bill the insurance company, and it can be months later and everybody's still haggling about who owes what and what's going to happen. They're hoping to clean that up with this section right here. Doctor bills the carrier. The carrier has 30 days to pay or deny the claim. Once they've paid it or denied it, if the provider is not happy with the solution, that provider has 7 days to start negotiations and notify the carrier that they're going to go to arbitration, or vice versa. The carrier could notify the doctor that they want to start negotiations and go to arbitration. What they hope is this keeps claims from dragging on for months and months and months. And I'm sure a lot of us have had clients that that's been true with. Hospital transparency requires the hospital and surgery centers to provide understandable and clear pricing information online about services, billed charges, minimum and maximum pricing, negotiated rates, cash prices, for 300 of their most utilized services. In that 300, the federal government's going to set 70 of the 300, and then the hospital would pick the other 300. This got me to thinking. There's 300 services that they have to provide benefits for, their most 300. But what pricing do they have to provide? That's the question. So the pricing they have to provide is clear and understandable pricing. Billed charges 1. Minimum and maximum, that's 3. Negotiated rates, that's 4. Cash prices make 5. Well, 300 times 5 is 1,500 numbers they've got to provide in a clear and understandable format. The problem is, how many insurance companies does a hospital deal with? I think 50 different sets of rates would be conservative. Maybe you think 50 would be conservative. 1,500 times 50 is 75,000 numbers they're supposed to present to us in a clear and understandable fashion. I think that's staggering. The other part that's interesting is, should the hospital decide that they're not going to do that, they only owe a penalty of $300 a day. It'd be cheaper for the hospital to not provide the clear pricing requirements and pay the $300 a day than to provide them, I'm guessing. The last thing in this section on the No Surprises Act is a mandatory commission disclosure. I don't know if you've heard about this yet or not, but all brokers, pharmacy benefit managers, wellness vendors, third-party administrators, all of us are going to be required to disclose commissions to our employers or our clients on everything that we do. Now, at first I thought, my gosh, this is impossible. I'm going to write an individual health plan and I got to tell them I'm going to make $180 off the individual health plan. The good news here is it's only if you expect to make more than $1,000. The bad news is it not only includes the commissions, bonuses, trips, anything that you think, meals, anything you think you might get as a result of writing that policy. We're waiting for further guidance, but it's something you're going to want to keep track of. That starts at the beginning of the year, so we all need to figure out what's going on. Look for guidance on that later this year. That brings us to the executive order section. Every time there's a new president, the new president doesn't want to operate our country the way they're supposed to, i.e. pass laws through the House and the Senate. So they sit up there like a king writing an edict, and they just do these executive orders. And they say, we're not going to do this now, we're going to do that now. So here's the executive orders I have that I think apply to us. Insurance companies now have to pay for COVID tests required by employers for an employee in order to return to work. What's happening here is this. Insurance companies are supposed to pay for medical expenses, and medical expenses would be if I didn't feel good, right? I feel sick, I was exposed to someone with COVID, then the insurance company says, okay, I'll pay for you to get a COVID test. These COVID tests have run between $100,000 and $500,000 a month, depending on where people did them, who charged what. They can be really expensive. What if I just want Tom to do a COVID test every couple of weeks because I'd feel more comfortable as an employer? Or I want him to do one after he's quarantined for 14 days before he comes back to work. The insurance companies were pushing back saying, hey, we shouldn't have to pay for that test. That's not a person who's ill. It's not like doing a colonoscopy or a cholesterol test or a blood pressure test. They're doing that just because they want to. Well, it's all over now anyway because the President Biden signed an executive order to say the insurance companies have to pay for that COVID test in order for people to return to work. PrEP is a medication that people would take if they wanted to not catch HIV. It's an HIV preventive medication. If you take PrEP prior to having sex with people, it's about 95% effective at stopping people from catching AIDS. Phenomenal drug. The problem was it's about $2,000 a month, $24,000 a year. That's now going to be covered at 100% by most all plans just like a preventative care medication, like a pap smear or a mammogram for women, or cholesterol or blood pressure screening for men. Now they have to cover this PrEP medication at 100%. No copay, no charges for the person taking it. If you know someone that might be helped by that, that's something you're definitely going to want to let them know. Special enrollment period to buy an individual health plan. Most all of us already know this has been extended to August 15th already. So it started in February, it's going to run until August 15th. Unemployment cannot be discontinued if a job opens back up, if you don't want to go to work. The way unemployment's traditionally worked is I laid Tom off, I got a job, I offered Tom the job. If Tom decided not to take the job, he lost the unemployment. What this executive order says is Tom can just say that he doesn't feel safe and he doesn't want to work, and he gets to keep the unemployment. You might have noticed that a lot of restaurants, bars, hotels are starting to post signs saying to be kind to the employees that are working, because they just can't hire people anymore. This is one of the reasons they can't hire them. People are making more money not working than they make working, and they have they're not compelled to go back to work. Small group, keep your plan through December 31st. This applies to the grandmothered and grandfathered plans. They were supposed to expire. You were supposed to have to move to a ACA compliant plan. They're saying that you don't have to move to the ACA compliant plan. You get one more year until the end of 2022. Those of us that have been keeping up with this know every year they just keep extending it because they don't want to force people to buy the more expensive plans. Unused flexible spending account benefits roll over from 20 to 21. Normally, a flexible spending account is use it or lose it. If we remember, these are employee dollars. Craig may say, I want to set aside $100 a month. I could use that $100 a month for glasses or co-pays or prescriptions. If I got to the end of the year and there was no money left in that account, then I lost that money and I started over again at the beginning of next year. They're saying here the benefits are rolling over from 20 to 21, meaning if I had unused dollars at the end of 2020, I now get that money moved over to this year. The risk there was always for the employer, because the employer has to make the dollars available. As soon as I say I'm setting aside $100 a month, they have to make $1,200 available to me on day one. The lose it piece was to reimburse employers that might have lost some money during the year. The patient protection funds, not the patient protection, the PPP funds, where everybody got those for their employees, they have now been extended to be able to be used for life insurance, disability, dental, vision, as well as paychecks and health insurance. That was to help people meet that mandated, 80% in wages, 20% in ancillary expenses. They've expanded it to include life, disability, dental, vision as an expanded benefit to help you meet those requirements of the 80-20 rule. Medical expense deductions moving from 10% to 7.5%. The way this works, Craig makes $100,000 a year. He has medical expenses of $15,000 this year. Under the old rule, it had to be above 10% of Craig's adjusted gross income to be able to deduct it. $100,000 times 10% is $10,000. If Craig had $15,000 in medical expenses, he could deduct that $5,000 above the 10. What they did is they lowered that from $10,000 to $7,500, meaning now if Craig had $15,000 in medical expenses, he can deduct $7,500. 100% of business meals can be written off until December 31st, 2022. That's nice for employers or those of us that are self-employed. Extension of the Family First Coronavirus Relief Act with the following mandates. extends the business tax credits for emergency paid sick leave and family medical leave through December 31st. That's where an employer can take a tax credit for paying wages to an employee who had to miss work. I added the bottom part of this slide for those of us that are self-employed. None of us ever think about getting a tax credit for us having to miss work because we were sick, but we can do that. And you have a choice of using either the prior year or the current year, whichever one your wages are higher, and taking a tax credit for you missing work because you were sick or had family medical leave. If you're self-employed and you were sick this year, you want to pay attention to that. Extension of unemployment from 39 to 50 weeks. They get an extra $300 a week. This is the reason, people are making $550 a week without working. Why would they go to work and make $500 or $600 a week? So that's one of the problems employers are having today. An employer can make pre-tax loan payments for an employee up to $5,250 a year for student loans. If I had somebody that was working for me, I can pay their student loans up to $5,200 a year tax-free. Nice benefit. ICRA versus QESRA. When President Biden took office, he signed an executive order to review these rules. I was reading this morning, my original thought was he was going to eliminate the ICRA. QESRA was around prior to President Trump signing that executive order that created the ICRA. And this individual coverage HRA or qualified HRA, the idea is, can an employer give the employee tax-free dollars to buy an individual health plan? The answer to that question is yes. That's done through either an ICRA or a QESRA. Normally, when somebody buys an individual health plan, I ask Tom, well, how much are you going to make? Tom says $40,000 a year. I say, great, Tom, you're going to get $1,000 a month in subsidies. You'll pay $200 for your health insurance, and the federal government will pay the other $1,000. With QESRA, originally, the employer could give a tax-free dollar to Tom of $200. Tom could take that $200 and the $1,000 the government was giving them and get free insurance. When the ICRA came along, they said, no, the employer contribution is going to reduce the subsidy. So now Tom gets a $1,000 subsidy. The employer says he's going to give him $200. The subsidy is reduced to $800. The $200 from the employer is kicked in, and Tom still has to pay $200 for his health insurance. To me, it kind of removed the value of the ICRA and the QESRA. I'm thinking, why should the employer even put dollars in at all when it only reduces the amount of subsidy that they get? You can decide whether that's right for your client or not. The new rules are going to continue to allow this. I was reading about this morning. So you will still be able to do an ICRA and a QESRA. Supreme Court case, hopefully most of you have heard by now, when the Democrats were passing the Affordable Care Act, we're going back to, 10 years ago, and they're passing the Affordable Care Act, they argued that the individual mandate was non-severable from the rest of the law. Anybody that's ever signed a real estate contract, you're familiar with the severability clause. What the severability clause says is, if any piece of this contract is found to be illegal, the rest of the contract stands. The Democrats argued that it was non-severable, meaning if the individual mandate was found to be illegal, they didn't believe the rest of the law could stand. President Trump got elected. He set the individual mandate penalty to 0. When he did that, a bunch of states sued in Texas and said, hey, the individual mandate's been set to 0. The Democrats argued it was non-severable. The whole law should be thrown out. A judge in Texas actually agreed to throw the whole law out. It got appealed to the Ninth Circuit Court of Appeals, a 3-judge panel, and that 3-judge panel actually agreed also and sent it back to the Texas judge to explain exactly which parts of the law he wants to throw out and why. We all thought that the Supreme Court would immediately take this case up in the winter of last year before the election, that they would hear the case and issue a ruling before the presidential election last year. They didn't. They actually heard the case in the fourth quarter last year. They're due to issue a ruling this summer about whether they're throwing the law out or not. So look for more information on that later. This brings us to the American Rescue Plan. Everybody's familiar with the American Rescue Plan because they all thought they were getting a $1,400 check. That was $1.9 trillion bill. The $1,400 only amounted to $410 billion of $1.9 trillion. The question then is, what happened to the rest of the money? Well, here's the good news. I'm not going to tell you what happened to all the rest of the money. I'm only going to tell you what happened to some of it. We increased unemployment $300 a week and extended that for longer. $50 billion got set aside to go to coronavirus testing, contact tracing, increased size of public health workforce, funding vaccine distributions and supply chains. Here in Florida, when a woman is pregnant and she is on Medicaid, historically she only stayed on Medicaid 60 days postpartum or after the birth. That's now been extended to 1 year. So women that have a baby will stay on Medicaid for a year. Some people ask, where does this money come from? Not all of it's coming from this, but some of it is coming from the fact that there's a 4% reduction in Medicare pay-go provision. That is the amount that Medicare pays to doctors, hospitals, etc. They're reducing the amount that they pay. So doctors will get less money for treating Medicare people. COBRA. Just to bring us all up to speed, Tom works for Craig. Craig had to lay Tom off last year. The way that rule works is I had 45 days to notify Tom that he was eligible for COBRA. Tom had 60 days to elect it. If he elected the COBRA, he owed premium back to date of termination. In the middle of the pandemic last year, lots of people got laid off from their jobs because of everything that was happening. I might have asked Tom if he wanted COBRA. Tom looked at it and said, well, I just lost my job. The whole world's shutting down. COBRA is expensive. I can't afford it. No thanks. I don't want it. What the American Rescue Plan has said is all employers are now required to make a new COBRA offer to their employees that were laid off or fired, not people that quit, laid off or fired, and to offer them free COBRA starting April 1st, running through the end of September. Tom never took COBRA from me. I make a new offer to him. Tom, would you like COBRA? It's going to be free. Tom does not owe any premium back to date of termination. He doesn't have to do any of that. He just gets free COBRA starting April 1st through the end of September. I said it was free. We all know nothing's free, so who's paying for it? The employer has to pay the premium for the COBRA, and then they're supposed to take it as a tax credit against federal payroll taxes that they file quarterly. Many employers laid off 50% or 60% of their workforce last year. They're now supposed to pay for COBRA for 50 or 60% of the people and take it as a tax credit against 40% of the people's payroll. Only on the federal side, the FICA. I don't know how that's going to work out, but everybody's required to do it. And employers are required to now start sending notices by the end of May to notify all of the employees that they're eligible for this free COBRA. Premium tax credit repayment holiday works like this. We talked about Tom wanted health insurance. He said he was going to make $20,000 a year. I said, great, Tom, you qualify for $1,000 a month in subsidies from the federal government. Tom gets the end of the year. He sits down with the accountant. How'd it go, Tom? Oh, it went great. I didn't make 20,000. I made 40,000. The accountant would say, well, gosh, Tom, you shouldn't have gotten $1,000 a month in subsidies. You should have gotten $500 a month in subsidies. Tom owes $6,000 back to the federal government. Except he doesn't. What this says is for 2020, if anybody made more money than they said on their healthcare.gov application, they don't owe any of that tax credit back. The problem was this bill didn't pass until like the end of March, like the 20th of March. Many people had already done their tax returns and already repaid the money. We originally thought everybody was going to have to go out and file an amendment. The IRS is now saying you don't even have to file an amendment. We're just going to mail you a check for the amount of the subsidy that you paid back that you didn't owe. So people will get checks in the mail for a repayment of their tax credit. The third one is interesting, and this is a 2021 rule. What it says is, I'm married. My wife, Laura, has a job. Laura got laid off. She's received one unemployment check. Because she received one unemployment check in 2021, the entire family qualifies for the maximum allowable subsidy on healthcare.gov, i.e., free insurance, because my wife received one unemployment check. If you know people have been laid off or lost their jobs or getting unemployment, this could be a big benefit for them. Subsidies, enhancements. So the stuff we're getting ready to talk about is going to run through 2022. When I finish explaining it, I can tell you what I think is going to happen after 2022. But this is the whole reason we're really at this webinar. The other stuff is very important, and there's a lot of things we need to know in there, but this was a game changer for a lot of people. If you've ever heard me talk about healthcare, you know I always start with this chart because everything happens off this chart. Across the top is number of people in your family. Subsidies were available between 100 and 400% of federal poverty level, meaning a single person could earn about $51,000 a year, still qualify for a subsidy on the exchange. Family of four, 104,000. You get how that works. We're going to talk about three people. The first person is my buddy Dave. He made $52,000 last year. He's at 200% of federal poverty level. Show you why that matters in a minute. Me, I'm reading tax law and legislation all the time, so I made about $17,000 last year. I'm at 138%. The last one is a married couple, and they made $103,000 last year, and they're at 600% of poverty level. The reason why it matters is, depending on the percent of poverty level you're at, that determines what percent of your income you pay for your health insurance. 300% pays 9.83, 100% pays 2%. What happened to David? David was at 200% of federal poverty level. He's going to pay 6.5% of his income for his health insurance. We look at the bottom of the slide in black, 52,400 times 6.5 divided by 12. David could insure his entire family for $284 a month. When I'm asked if anybody benefits from healthcare reform, absolutely, David benefits big time. Except the middle column is the old numbers. The American Rescue Plan established the column on the far right, the new numbers. Now Dave's at 200% of federal poverty level. He's just going to pay 2% of his income. We look at the bottom in red, 52,400 times 2% divided by 12. Now David's insuring his entire family for $87 a month. What happened to Craig? Craig was at 138%. He was paying 3. Now he's going to pay nothing. I'm going from $45 to 0. Craig and Dave have one of two choices. They can call me today, redo their application. Their premium will fall from $45 to $0. If they did nothing when they got to the end of the year, the government would say, well, gosh, you shouldn't have paid $45 a month. You should have paid nothing. So 45, 49 times 12, they'd get a refund of $545 right on their tax return if they did nothing and got to the end of the year. That's true for Dave as well. Dave's got a difference of about $200 a month. So if he does nothing, he'll get a $2,400 refund at the end of the year. The third person is Eric. Now, Eric made $103,000, and it's a couple that's 60 years old each. So right now today, they're paying about $1,979 a month in subsidies. Those are real numbers. We ran the quotes. That's what they are. However, under the new plan, Eric doesn't pay more than 8.5% of his income. See, now if we go 103,000 times 0.085 divided by 12, Eric can get coverage for $732 a month. 1979 minus 732, Eric now qualifies for $1,247 a month in subsidies to help him buy his health insurance. This is a life-changing event for him. The problem Eric has is this. Unlike Craig and Dave, he doesn't get this money until he does the application. So he qualifies for $15,000 a year in help. But if it takes him 4 months to learn that he should do it, that's $5,000 that's just gone in Eric's life, and he never gets it back. Because until he does the app, he doesn't get the money. It's a really big deal. The problem I have right now is everybody, the insurance companies, the agents, everybody's focused on Craig and Dave. I'm not as worried about Craig and Dave. They're going to get their money back. If they do nothing, they'll get it at the end of the year in a refund. But Eric, it's costing him $1,247 because he didn't hear about this last month, and it's costing him $1,247 this month too. So until he knows, he doesn't get the money. The question everybody always asks is, yeah, Craig, but what kind of coverage do I get? There's 4 kinds of plans available in the exchange: bronze, silver, gold, platinum. Subsidies are based on a silver level plan. I enter David, I enter his wife, I enter his kids. I come back to David and I say, your plan costs $1,087. Dave says, hey, Craig, you told me I was only going to pay $87. That's right, David. That means you get a $1,000 subsidy to help you buy your health insurance. Once we've established the $1,000, David can move up or down this chart however he wants. So if he says, hey, Craig, I can't afford the silver plan, how much is the bronze? Bronze is $900. You got $1,000 subsidy. You pay nothing for your health insurance. Craig, I want great coverage. How much is the gold? Gold's $1,200. He's got $1,000 subsidy. He just pays $200 to insure his entire family. To give you some perspective here, the silver plans, it's like $30 for the doctor, $60 for the specialist, maybe a $3,000 deductible if you're admitted to the hospital. So pretty good coverage. What's the catch? The catch is this. I'm not asking David how much he made last year. I'm asking David how much he thinks he's going to make this year. Well, David doesn't know what he's going to make this year because this year hasn't happened yet. He says, I made $52,000 last year, $52,000 the year before. Craig, I think I'm going to make $52,000. We go to the exchange. David picks a plan. He picks Blue Cross. He mails his $87 to Blue Cross. Federal government mails $1,000 to Blue Cross. Life is great. End of the year, he sits down with the accountant. How'd it go, David? Oh, it didn't go so good. I got laid off partway through the year. I didn't make $52,000, only made $42,000. Oh, well, David, you shouldn't have paid $87 a month. You should have paid nothing. David's going to get a $1,050 refund right on his tax return. By the same token, how'd it go? Went great, got a promotion, got a raise, made $62,000. Oh, well, David, you should have paid 87. You should have paid 187. David owes $1,200 back due right on his tax return. Now, we know that that's not true for last year, but it's true for every other year.
Craig, I got a couple of questions here, if that's all right.
Yeah, go ahead.
One person asked, so what's the break point between having to file to get your premiums returned versus receiving your money automatically at tax time?
Well, it's going to be whoever paid them back. So if I didn't pay back, if I hadn't filed my return and paid the money back, if I already did that, then I'm going to get a refund mailed back to me. If I haven't filed my return yet, you won't pay it, so you won't need it refunded.
All right. And another question, if the individual's employer offers coverage, are they still not eligible for the subsidy? Or if the spouse's employer offers a plan, are they still eligible for subsidy?
Okay, well, let's start with the rule first, because that's going to make it easier to understand. If an employer offers a qualified plan that's deemed affordable, what's deemed affordable? 9.8% of the employee's income for employee-only coverage. Craig makes $20,000 a year times 0.098 divided by 12 is $163. If the employer offers me health insurance for less than $163 a month, then neither me nor my children are eligible for a subsidy on healthcare.gov, but my wife would be, assuming she wasn't offered deemed affordable coverage. So that's the rule. How are they ever going to know that I was offered deemed affordable coverage? Well, of course, if you're 50 employees or more, those companies are required to do the reporting. If you're under 50 employees, you'd have to self-report it when you did the application.
All right. And one more question, if you don't mind. It says free COBRA is covered until September. Is that September 1 or September 30?
September 30th.
All right. That's it for now.
All right. So let's go back to David, because David's really lucky. See, David was under 200% of federal poverty level. Because he's under 200% of federal poverty level, he qualifies for a second benefit called cost share. What that's going to do for David is lower his deductibles, lower his copays, lower his max out of pocket. To give you some perspective, we literally have clients that pay 70 cents a month in premium, $1 for the doctor, $3 for the specialist, $0 deductible, $500 max out of pocket, better than anything you can buy with any amount of money out of your pocket. There's one more important thing I think you guys should know. On healthcare.gov, we do backwards math. We don't do forwards math. What I mean by that is everybody's used to how much is it for me? It's $200. What if I want to add my wife? It's another $200. What if I want to add my kids? It's another $200. My math doesn't work that way. David wants health insurance. He made $40,000. He calls me on the phone. I say, hey, David, you're at 300% of federal poverty level. 300% of poverty level, he's now going to pay 6% of his income for his health insurance. 40,000 times 0.06 divided by 12. I say, great, David, I can insure you for $200 a month. David says, hey, wait, I forgot about them 2 kids. See, now David's a family of 3 making 40,000. He's at 200% of poverty level. 200% of poverty level, he's going to pay 2% of his income. 40,000 times 0.02 divided by 12. I say, hey, David, I'll insure you and the kids for $66 a month instead of just you for $200. Because, see, I do backwards math. More people cost less than less people. If David then said, wait, I'm married too, now he's going to be a family of 4 making 40,000. He's 150%. 150%, he pays nothing. So I say, hey, Dave, I'll insure you, your wife, and the kids for nothing instead of just you for $200 because I do backwards math. More people cost less than less people. this is probably a good chance for me to pause for a minute and see if there's any other questions.
Yeah, just one more, Craig. It says, I thought that the former president had gotten rid of the cost share reduction in 2019, question mark.
All right, so it's a little bit complicated here. Here's what I want to say. He did not get rid of the cost share reductions. What happened was the Democrats were in a hurry to pass the bill. They wanted to pass it before anybody read it, and I guess that really included themselves too. When they passed the bill, they funded the tax credit, the subsidy. They created the money and they funded it. But when they created the cost share reduction, they never funded that. So President Obama said, hey, look, not a problem. I'll take care of it. And he went over and grabbed cash out of the Treasury and handed it to the insurance companies, and went and grabbed cash out of the Treasury and handed it to the insurance companies. If you know much about our government, what we know is the president cannot spend money. Congress spends money. It's not legal for the president to grab dollars and hand them to someone just because he thinks it's a good idea. Actually, it's not even legal if it is a good idea. So when President Trump got elected, he said, hey, I can't pay for that. I can't grab cash and hand it to the insurance companies. What they told the insurance companies to do, and what the state of Florida had them do, because we were ahead of the game on this, is we asked the insurance companies how much it cost them to provide that benefit. It's only on a silver plan, and they answered 30%. So the state of Florida told the insurance companies just to raise the premium on their silver plans by 30%. Now, the irony is, we'll see if anybody's paying attention. Does David care if premiums go up? Well, the answer to the question is no, because I didn't calculate David's subsidy. I calculated what David pays. See, David's at 200%. He pays 2% of his income, 87 bucks. Well, if the premium's $87, Dave pays 87. What if it's 287, 587, 1,087? Dave still pays the 87 bucks. In an odd way, the government's now funding that cost share benefit legally because subsidies are based on silver. Silver prices went up by 30%, and the tax credit went up by 30% to account for it. How's that for a long explanation?
Outstanding. That's great.
Any other questions?
No, not at this time, Craig.
You know, when you have no questions, Tom, you always think to yourself, wow, you either did a really good job or a really poor job, is the way I always look at that.
No, you did a great job.
All right, we'll give a minute and see if anybody has any other questions. It's quite a bit of material.
All right. While we're waiting for questions to come in, please be aware that Paula has posted in the chat feature the signature form that each one of you will need to do to take care of. And you can send it back in a little later, but just be aware that that's there. And let's check the chat feature one more time. One person says, holy cow, how do you keep up with all these changes, Craig?
A lot of reading. So I have one other thing I want to cover, Tom.
All right, that's fine.
So here's the thing. We have a really big problem right now. And the big problem we have is because the presidents have been doing everything by executive order, our country was never meant to run that way. But it's caused all of us to be completely confused about what's happening. The easiest example is President Trump eliminated the individual mandate. That's the mandate that said Craig has a mandate to own health insurance or pay a penalty. Now, he didn't eliminate the law, he just set the penalty to 0. But the problem is many employers that had more than 50 employees, they thought their mandate had been eliminated as well, because those employers have a mandate to offer deemed affordable coverage or pay a penalty. Well, their mandate was not eliminated. It was just the individual mandate. And many of those employers never put that coverage in force. And the government has been so slow in mailing out letters and charging those penalties that people think it went away. I have an employer that just got a letter and just got fined for January and February of 2016, 5 years ago. If you as an agent or you as a person have a friend, have a client, know of a business that has more than 50 employees, they need to be offering coverage that's deemed affordable, because those penalties are huge. It's $3,000 a head for every head past 30. So you say, man, that's 100 employees minus 30 is 70 employees times 3,000 is $210,000 in penalties. It's put you out of business money. The second problem they have is they believe that by having more than one company, they've avoided the 100 employee mandate. The idea here would be I have a Burger King with 30 employees and I have a Subway with 25 employees. See, Craig, neither employee has more than 50 employees. Neither company has more than 50 employees. No, because there's common ownership. If the same person or block of people own 51% of the company, that's common ownership. Those companies have a mandate to offer health insurance, even though neither one of them has more than 50 employees. We as agents, we need to be communicating and trying to help all of our friends, all of our clients know that they have to do this. Now, on the other side, the employer may say, there's no way I can pay for health insurance for 100 employees. What we have to help them understand is your mandate is to offer. You have to offer a qualified plan that's deemed affordable. We go back to Tom and we go, Tom made $20,000 times 0.098 divided by 12 is $163. My mandate is to offer Tom coverage at $160 or less. It doesn't matter if Tom takes it or not. I've met the mandate. I have a lot of large employers, 50, 80, 100 people, where 7 people, 12 people are enrolling because everybody's going to the exchange and getting subsidies, even though they shouldn't be able to do that. But the government's not monitoring that either. But they are going back after those employers. And this current administration will be much more punitive to the employers than the last administration was. So please, I'm begging you, think about your clients and figure out who needs to be offering coverage today. All right, any other questions?
Yeah, we had one more here, Craig, if you don't mind. And it says, if you have an ACA plan and your health insurance coverage is being subsidized, do you ever have to pay back the difference? For example, if the total cost is $1,300 per month and I pay $400 per month, does the difference have to be paid back if it's in 5 years, I inherit the money, or will I have to pay the difference back? Thank you.
The way someone owes the money back is, remember, Dave was guessing how much he thought he was going to make this year, $52,000. When Dave gets to the end of this year and he does his taxes, he's paying it back right then if he owes it based on income this year. So if Dave goes from $52,000 to $62,000, they go, hey, you shouldn't have paid $87,000, you should have paid $187,000. Dave's paying that $1,200 back due right on his tax return. Once that tax return's filed and you're done, nothing that happens to you in the future matters. And frankly, nothing that happened to you last year matters. Dave might have had a better job last year and made $150,000 last year. That's not relevant to him qualifying for a subsidy this year. It's how much do you think you're going to make this year? Who are you claiming on your tax return? What is your household income? I used to think that was a simple question. There's W-2 and self-employment. But if you really study this, there's Social Security, supplemental Social Security disability, alimony, child support. Some of these things we count, Some of these things we don't. Alimony, did it start before 2019 or after 2019? That affects whether I count it or not. So what is income is a complicated question. And who are you claiming on your tax return? Think about David. You know, David gets divorced. This year he claims the kids, next year he doesn't. The next year he claims the kids, the next year he doesn't. Well, now that you understand how the numbers work, you know his health insurance premium is going up or down based on whether he claims them or not. We have clients that are legally supposed to claim the kids this year. We do the app, they pay their subsidy, and at the end of the year, somebody runs out and claims the kids before they do. And all of a sudden they become a one-person family, and their premium goes from, what was that, $80 to $200, just like that, because they can't claim the kids anymore. Any other questions?
One more question here. It says, could a single person making a little over poverty level for a health insurance subsidy then? Is there a website to learn more about that?
Yeah, I mean, if you're making $13,000 a year, you get unbelievable, incredible insurance for nothing. So they can go to healthcare.gov. They can call us if they want help trying to figure all that out. I'll put my stuff up here. I'll also tell y'all, if you have questions, feel free to call me. You know, if you have questions about what we talked about today or what you can or can't do, you can call me.
All right, there's his phone number, 407-937-2900, 407-937-2900, Craig Rodrigue. And Craig, we had a question early on, and I think now's an appropriate time to ask it. And essentially the question is, who's going to pay for all these freebies?
That's a great question. If you think back to President Obama, and President Obama did his bailout bill, and we were losing our minds. We're like, where is all this money going to come from? How much was the bailout bill President Obama did? It was $980 billion. We have now already spent $6 trillion in COVID relief. They have another $4 trillion that President Biden wants to spend. They want to spend $10 trillion under the COVID relief bill. We lost our mind over President Obama's bailout package, which was only $980 billion. I have no idea where all this money is coming from, Tom. The Chinese, we're going to print it. I have no clue. But with our federal budget, if you look at everything the federal government spends money on, everything, military, all social programs, everything is $4 trillion a year. And we're about to spend $10 trillion in COVID relief. It's incomprehensible. And here's a fun fact. What comes after trillion? You know, we're spending trillions now like it's nothing. So what comes after a trillion? It's a quadrillion. And I'm like, we're now into crazy town territory where when you were a little kid and you were on the playground, you'd be like, I'll bet you $1 quadrillion you won't jump off the slide, you know, or kiss Mary. So we're into crazy town. I have no idea where the money's coming from.
All right. Well, thank you very much, Craig. We appreciate it. Everyone just hang on.